The world holds its breath. Is a new trade war brewing? The echoes of previous disputes have barely faded, and already ominous shadows of new economic battles darken the horizon. The Ministry of Finance has announced a sharp increase in tariffs on American goods imported into China, from 34% to a staggering 84%. In response, President Trump has vowed to impose an additional 50% tariff on Chinese goods, bringing the total tax on imports from China to a colossal 104%. China has retaliated in kind, mirroring the increase in tariffs on American goods to 84%, significantly exceeding the previous 34%. These events stand in stark contrast to the situation on April 9th, when President Trump suspended most tariffs imposed on U.S. trading partners for 90 days. At that time, the stock markets reacted with an immediate, albeit short-lived, rally. However, it appears that an important detail was overlooked in the calculations: China. A critical moment has arrived in the trade war between China and the United States. Instead of the anticipated easing, tariffs imposed by the Trump administration have surged, reaching 125% on Chinese goods, prompting an immediate response from Beijing, which raised its own tariffs on American products to 84%. But China hasn't stopped at mirroring measures. In response to pressure from the U.S., the Chinese government appears poised to deploy a powerful financial tool capable of destabilizing American markets. The possibility of selling off a significant portion of China's reserves held in U.S. Treasury bonds is being considered. According to some reports, the possibility of selling bonds worth between $900 billion and $1.1 trillion is under consideration. Such a move would be tantamount to a trade atomic bomb, sending shockwaves not only through Washington but also throughout the Trump administration. But what is behind this decision? Why is China considering selling bonds as a retaliatory measure? And why are American stock markets reacting so strongly to this prospect? These questions require detailed analysis to understand the depth and potential consequences of the unfolding conflict. Let us take a close look at the unfolding picture, for the events to come have the potential to shake not only the two nations but also the foundations of the global financial system. Let's consider all the nuances, expert assessments, and possible consequences. The prospect of China selling American bonds has long seemed unlikely. However, the resumption of trade confrontation on April 2, 2025, changed many predictions. According to information circulating on social media, China has ordered its central bank and banking sector to reduce the purchase of American currency. At the same time, news sources report a partial reduction in China's holdings of Treasury bonds. All this indicates that Beijing is preparing to use its last argument in the dispute with the Trump administration, which is increasing pressure on China through tariffs. Analysts fear that a massive sell-off of American bonds by China could trigger a sharp spike in financing costs for the United States, collapse the dollar, fuel inflation, and destabilize the domestic market. In economic circles, such a scenario is compared to the detonation of a commercial atomic bomb against the American economy. An excessive dumping of bonds could trigger a real panic in the financial markets. China, as one of the largest creditors of the United States, has for many years channeled surplus currency earned from foreign trade into the purchase of American bonds. In this way, China financed the U.S. current account deficit and ensured the safety of its own reserves. However, according to some experts, the protectionist policies of the Trump administration, in particular the introduction of tariffs reaching 104%, have strengthened the view in Beijing that China needs to use its economic trump card. Rumors circulating in international media that Chinese banks have been instructed to stop buying dollars suggest a possible gradual exit by Beijing from dollar assets. This process, if it is indeed taking place, could have far-reaching consequences for the global financial system. The current collapse in the bond markets serves as a compelling confirmation of growing anxiety. The British press reports a deepening sell-off of American Treasury bonds, pushing yields up and sowing chaos on Wall Street. It seems that Trump's plan to build a tariff wall has turned into a panic, the epicenter of which is the U.S. bond market. Analysts on social media have long discussed the possibility that China may resort to selling its bonds. However, until now, Beijing has refrained from using this weapon. The reason is that a massive sale of American bonds could undermine the value of China's own reserves. Moreover, the economic interdependence between the two countries is so significant that such a move could result in a mutual loss. Nevertheless, as autumn 2025 approaches, the tension caused by the Trump administration's tariff policy reaches a new peak. China has reportedly announced the imposition of additional 84% tariffs on goods from the United States, indicating a serious rift in trade relations between the two nations. Despite Trump's claims of seeking an agreement, there is no starting point for negotiations, and the ball is in Beijing's court. China insists on a preliminary reduction of tariffs, creating a stalemate. In this context, a scenario in which China could strike the U.S. on the financial front by selling American bonds becomes increasingly realistic. However, the question arises whether China will dare to take such a step. Some analysts believe that a large-scale sale of bonds could harm Beijing itself, devaluing its remaining dollar-denominated assets. Nevertheless, experts do not rule out that in the event of a protracted trade war that destroys economic interdependence, China may accept partial losses to create problems for the U.S. financial market. According to some analysts, the Trump administration, which actively used tariffs as a tool of pressure, may have overestimated its effectiveness. Now, according to some experts, Beijing is ready to lay its main trump card on the table. Moreover, China's actions may not be limited to selling bonds. Ordering Chinese banks to reduce dollar purchases may be part of a broader strategy aimed at limiting the dominance of the American currency in world trade. In light of the growing threat of sanctions pressure, Beijing is showing strategic foresight, seeking to diversify its reserves and develop alternative financial instruments, such as the digital yuan. Such steps indicate a long-term orientation that goes beyond simple bluffing. Rumors of a possible sale of U.S. Treasury bonds by China have already caused significant turbulence in U.S. stock markets. The introduction of new tariffs has only exacerbated negative investor sentiment, triggering a sell-off in the bond market. Many investment funds, traditionally viewing bonds as a safe haven, succumbed to panic, fearing that a Chinese bond dump would lead to higher interest rates and inflation, which in turn would collapse the value of bonds. This fear of asset devaluation has created a new round of instability in the stock market and put pressure on the dollar's exchange rate. The Trump administration, on the one hand, demonstrates determination in the trade war, signaling its readiness to further apply tariffs. On the other hand, signals of openness to negotiations with Beijing are coming from Washington. Analysts warn that a large-scale sale of Chinese bonds could seriously damage the U.S. borrowing structure. Such a scenario could force the Trump administration to seek compromise solutions in the trade dispute as soon as possible. However, neither side is showing any willingness to retreat immediately. According to some analysts, a massive sale of American bonds could be the last serious argument in Beijing's arsenal. Although China has other opportunities to maneuver its reserves, such as developing a digital currency and expanding trade in national currencies in Asian markets, selling bonds is seen as the most powerful, although perhaps not the only, tool of influence. In Washington, there is a prevailing view that such a move by China could cause serious shocks to the American economy. Panic sentiments are already circulating on social networks, reflecting concerns about the possible consequences. In American political circles, there are warnings that a large-scale Chinese bond dump will lead to an explosive increase in interest rates and an inevitable recession. Some members of Congress have already begun to address the president with warnings that continuing the tariff war could turn into a painful blow to America itself. At the same time, experts are wondering how effective the sale of bonds will be on the scale that China is capable of. The total size of the U.S. bond market is enormous, and Chinese reserves are estimated at between $900 billion and $1 trillion. A decision to massively dump American bonds on world markets could cause a short-term but powerful spike in yields, while weakening the dollar. However, China itself will not escape the negative consequences. The value of the remaining bonds on the balance sheet will plummet, and foreign exchange reserves denominated in dollars will be depleted. However, there's a less drastic scenario where China might resort to targeted bond sales, sending a clear signal to the U.S. market. While not a financial atomic bomb, such a move would significantly strain the already tense relationship between the two countries. The U.S. administration has already warned China against such actions, hinting at the possibility of imposing harsh financial sanctions if they occur. The prospect of a repeat of the asset-free scenario similar to what happened to Russia after the start of the conflict in Ukraine is causing serious concern in Beijing, prompting the need to reduce dependence on American bonds. In the long term, this could lead to a gradual reduction in dollar purchases and a shift to alternative currencies, which would be a significant blow to U.S. dominance in the global financial system. There's widespread discussion on social media that a protracted trade war could slow global economic growth, trigger inflation, and reduce consumer demand. Some experts even suggest that China might be the only beneficiary of Donald Trump's tariff policies. This scenario is driven by the fact that a massive outflow of capital from U.S. bonds could undermine investor confidence and open new horizons for other Asian markets. Even Trump's attempts to ease the situation by suspending some tariffs have failed to calm the markets. The epicenter of the financial earthquake seems to be in the bond market. Analytical reports, such as Why China Buys American Debt with Treasury Bonds, remind us that Beijing previously viewed U.S. Treasury securities as a safe haven for excess export earnings. However, as relations between the countries deteriorate, the image of this safe haven has begun to crack. The key question now is what will happen if China starts actively disposing of U.S. bonds. In this context, the reaction of other countries holding significant amounts of U.S. debt is also of interest. There's growing concern in the corridors of the global economy. Are we on the verge of a new recession? Japan and several European countries fear being drawn into the vortex of turmoil in the bond market. The reason for this is the steady rise in interest rates in the United States, which could fundamentally change the direction of global financial flows. Investors, like migratory birds, are ready to leave their familiar places. If America smells trouble, it's time to seek refuge in other markets. Thus, not only the relationship between the U.S. and China, but the entire global economy is in anxious anticipation. History teaches us that trade wars, flaring up against the backdrop of financial instability, can trigger a global economic downturn. The protectionist measures of the 1930s, which foreshadowed the Great Depression, come to mind. Of course, we live in an age of high technology, and many will rush to say that the situation is fundamentally different. However, no one is taking what is happening lightly. China seems willing to make a deal but doesn't know where to start this complex conversation. We're waiting for their call, Trump retorts, and in these words, there's a hint of a big game. Social networks are buzzing, trying to decipher the intentions of the American president. Is it a bluff or a firm intention to curb the trade deficit? Beijing, in turn, puts forward a counter-condition. Remove the tariff barriers, and we will reciprocate. If a compromise between the parties is not found, China has one last, but very significant, argument: a massive sale of American bonds. The scale of this action will be decisive for further developments. Will Beijing decide to completely sell off its reserves or limit itself to dumping billions of dollars daily? In any case, such a move could trigger a real storm in the U.S. financial markets, collapse the dollar, send interest rates soaring, and significantly increase the threat of a recession in the American economy. Some analysts believe that such aggressive actions will backfire on China itself. However, the policies of the Trump administration are increasingly cornering Beijing, leaving it no other choice. In this regard, a logical question arises: has the Trump team encountered a real trade atomic bomb? Perhaps such an analogy seems somewhat exaggerated, but a massive exit of China into the U.S. bond market as a seller is indeed fraught with chaos. Many economists agree that in the current situation, bonds have become the main target in the escalating tariff war. The Guardian headline, "Sharp Sell-Off, Panic Deepens," perfectly reflects the market's reaction. Investors are hastily divesting their bond holdings, fearing that a prolonged continuation of this trend could severely damage the U.S. economy. The surge in U.S. bond yields leads to higher borrowing costs for the United States and simultaneously fuels inflationary pressures. This destabilization, as feared on social media, could trigger a deep recession as early as 2026, which would spare even Donald Trump's electoral base. At the same time, voices are asserting that China is merely exercising its legitimate right to protect its own interests. Beijing is likely to take steps to distribute risks by requiring its banks to reduce their positions in dollar-denominated assets. Retaliatory tariffs, reaching 84% on imports from the U.S., indicate that trade relations between the two countries have reached a critical boiling point. Some commentators have been quick to declare China the outright victor in this standoff, predicting serious losses for American exporters of agricultural products, automobiles, and high technology. However, the Asian press maintains a more balanced perspective, characterizing the situation as a double-edged sword, noting that Chinese exports will also suffer significant losses. Ultimately, this is a scenario where all participants lose. Global financial centers are sounding the alarm, calling for an end to the chaos in the bond market, warning that otherwise the world could be engulfed by a wave comparable in scale to the 2008 financial crisis. The world stands on the cusp of epochal changes, according to analysts closely monitoring developments on the global stage. The trade confrontation between the United States and China, having gone beyond economic battles, threatens to escalate into a full-blown financial crisis that could erupt at any moment. There is a growing consensus among experts that what is happening is nothing more than Trump's panic. Faced with the growing threat, the White House would seemingly seek a quick compromise, but the president's administration is demonstrating unwavering firmness in its statements. Such stubbornness, as commentators on social media note, could have catastrophic consequences for the global economy. The bond market, which had been buoyed by the recent rally, collapsed under the weight of the tariffs that had come into effect. Investors had hoped for a delay or a diplomatic resolution, but their expectations were not met, triggering a panicked sell-off of assets, according to Reuters. Forbes is raising concerns, warning that the rally in the U.S. is under threat as China may resort to selling U.S. bonds. CNBC, in turn, is analyzing possible scenarios for Beijing's response, not excluding a blow to the U.S. housing market. Rising bond yields could lead to higher mortgage rates and, as a result, lower demand for real estate. Thus, the domino effect caused by instability in the bond market could intensify, confirming fears that in the event of an escalation of the trade conflict, the People's Bank of China may resort to selling its assets in U.S. bonds, which would be equivalent to a trade nuclear bomb. In this tense situation, many are wondering if Donald Trump is ready to stop this escalation. There are arguments that China is also not interested in damaging its own economy. However, the reality is that the tariff confrontation has turned American bonds, the cornerstone of the global financial system, into a potential target. Even if China does not go for a one-time sell-off, it can put pressure on the U.S. by gradually reducing its investments. Social media notes that for many years the link between American and Chinese bonds has been a symbol of interdependence, but now the threat of breaking this link is becoming more real. Resolving the situation hinges on a choice between concessions from Trump or China, but the national pride of both sides seems to preclude compromise. This raises serious concerns about the prospect of a protracted trade and financial conflict that could last until 2026. Recently, there have been increasing fears that China may use the so-called bond atomic bomb by dumping a significant amount of American debt obligations on the market. Such a move could certainly cause serious turmoil in the U.S. financial system and the global economy as a whole. Whether this will turn into a complete collapse for the American economy or remain just a loud bluff remains to be seen. However, it is clear that the consequences could be very painful. The United States itself would be the first to suffer, facing rising interest rates and a decline in investment attractiveness. The question of who stands to lose more if Donald Trump doesn't compromise on trade disputes is equally pressing. Escalating the conflict could create serious problems for both sides, as well as the entire global economy. Amid rising tensions, all eyes are on how the world will react if China actually starts a massive sell-off of U.S. bonds. It's impossible to predict the exact consequences, but it's clear that unleashing a trade and financial war would result in chaos, with no winners. We will continue to closely monitor the situation surrounding the bond atomic bomb and promptly inform you of all key developments. Stay with us to stay up to date on the latest news and analytical